Welcome to Land of Finance. We need to talk clearly about what happened to your portfolio last night while you were sleeping. If you glanced at your screen this morning, you probably saw what looked like a crime scene. Silver, which was trading at $83 just yesterday, suddenly went into freefall and stopped at $73.72. We're talking about an approximately 14% drop that happened within minutes. This is the kind of volatility that rarely occurs in markets, the kind that wipes out accounts, destroys confidence, and forces people to panic sell at the absolute bottom. But here, we need to make a very important distinction. What you just experienced was not a market correction. The fundamentals remain the same. Demand for silver did not disappear. Retail investors did not suddenly take profits en masse. No bubble burst. What happened was a completely mechanical event. At the moment of the lowest liquidity of the year, during a time window, when virtually no one was in the market, a forced algorithmic execution occurred in the dark. Call it a financial assassination or a system failure, but it was not a natural price movement. If you panicked this morning and sold your silver, you didn't just lose money. You also became a victim of what's known as a value risk shock, or in market terms, a V-shock. To understand why silver collapsed so violently today, December 29th, 2025, I want you to look not at the headlines but at the clock. This crash did not happen at the New York Stock Exchange Open. It did not happen during the London Fix. It did not happen during active intraday trading hours. It happened at exactly 2 a.m. Eastern Standard Time. Now ask yourself this question. Who is trading silver at 2 a.m. on a Monday night during a holiday week? The retail investor in Ohio? No, they're asleep. The silver stacker in Germany? No, it's lunchtime. A pension fund manager? No, most likely skiing in Aspen. The period between Christmas and New Year is known in markets as Ghost Week. At these hours, the market is essentially abandoned. The order book is empty. The buying walls that normally absorb sell-offs are nearly non-existent. Liquidity is paper thin, and that is exactly why the crash happened then. Around 2 a.m. low, a large institutional player in the market, most likely a highly leveraged hedge fund or a major prime broker client, hit the wall. This wasn't a small loss. They completely lost their maintenance margin. In the institutional world, when you breach margin requirements, no one calls you asking, could you add a bit more capital? You are liquidated immediately. And the entity doing the liquidating is not a human. It is a risk algorithm with a single mandate. That mandate is simple. Exit the position at any cost. It doesn't care if the price is $83. It doesn't care if it's $73. Technical levels, RSI, support, and resistance, none of that matters. It sells until the account is back within margin compliance. Under normal circumstances, in a liquid market, these sales would be absorbed. Buyers would step in and the price might fall a few cents or a dollar or two. But during the dead hours of Ghost Week, there were no buyers. The algorithm sold the first 1,000 contracts. The price dropped $1. It searched for buyers and found none. Dropped another $1, then another. 80, 78, 76. The market was searching for liquidity that didn't exist. This is called a liquidity cascade. Like an object falling from a height, it doesn't stop until it hits the ground. In this case, the ground was $73.72. That was the first level where the algorithm found enough buyers. So when you saw that massive red candle on the chart, don't think the trend is over. Imagine someone being liquidated in a basement. This was a historically large forced liquidation. Now we need to discuss a critical point, one the mainstream media deliberately ignores, but one that changes the entire story. This was a price-insensitive sale. The entity unloading the position did not sell because it wanted to sell at $73. It sold because it was forced to sell at $73. That distinction matters immensely. If investors had been selling because they believed silver is now worthless, this would have been a true bear market. But that's not what happened. What happened was the forced removal of an over-leveraged player from the system. This means weak hands were shaken out. Excess leverage was purged. The most fragile position in the market was eliminated. That large whale's position is now gone. That player is out of the game. Their capital is wiped out. And the market is now lighter, cleaner, and more prepared to move higher. But the story didn't end there. This first forced sale triggered a chain reaction. The second mechanism, the truly destructive one, then entered the system, gamma. When price broke below 78, then 76, another system activated. This was the risk framework used by market makers and options dealers. These institutions were short puts and long gamma. As price continued to fall, the math of those positions changed, and gamma flipped negative. Negative gamma means this: every time price falls, banks must sell more silver to stay hedged. This creates a vicious cycle. Price falls, banks sell to hedge. Selling pushes price lower. Banks sell even more. That's why, within seconds, what could have been a simple pullback turned into a full-blown collapse. Dealers became forced sellers alongside the liquidated whale. Due to their own risk systems, they began chasing their own market lower. This was entirely robotic, completely emotionless feedback. And all of this happened while you were asleep. That's why, when you look at that 14% drop, you need to understand this clearly. This move was not natural. This move was not driven by fundamentals. It was a synthetic crash created by forced algorithmic selling in a liquidity vacuum. It had nothing to do with silver's real value. It had nothing to do with solar panels needing silver. Nothing to do with mining supply issues. Industrial demand did not disappear. This was quite literally a plumbing problem. And as with any plumbing problem, when a pipe bursts, plumbers must step in and fix the system. Otherwise, the entire building floods. This is where the story stops being a simple flash crash and becomes a systemic rescue operation. When price hit $73.72, the system began to shake. Clearinghouses, the entities that guarantee all these trades, realized that the exploded whale might not be able to pay the bill. If that player defaults, responsibility transfers to the clearinghouse. If a clearinghouse fails, the risk is no longer limited to silver. The entire financial system is endangered. And right at the bottom, when everything looked like it was going to zero, massive liquidity appeared from nowhere. Billions of dollars. Specifically, a $34 billion emergency injection. You didn't see a headline. You didn't watch a press conference. But if you look at the repo market and the overnight central bank facilities, the fingerprints are unmistakable. Someone stepped in. Someone plugged the hole. And who that someone was matters. It was not retail investors. It was the system itself, saving itself. Now let's look at the number at the center of this story, $34 billion. This number explains why a bottom formed, because this crash wasn't just allowed to happen. It was controlled. The whale died, but the ocean survived. When price hit $73.72, alarms went off. Clearinghouses, the systems guaranteeing all trades, saw that the blown-up whale might not be able to pay. From there, things escalate fast. In futures markets, every position has a counterparty. For every long contract the whale held, someone else held a short. If the whale couldn't pay, that exposure lands on the clearinghouse's balance sheet. And if the clearinghouse defaults, it's not just a silver problem. The entire futures market, from oil to bonds, freezes. That's why around 3:30 a.m., while price was still whipping around $73, alarms began ringing at the Federal Reserve's overnight desk. Stress in the repo market was obvious. Banks didn't want to lend to each other. Counterparty risk, the fear of, what if I don't get my money back, surged to levels not seen since March 2020. No one wanted to touch the toxic balance sheet debris left by the liquidation. And that's when the fire hose came out. $34 billion in emergency liquidity was injected into the repo market. Let's be very clear about this. The Fed did not buy silver. They didn't care if price was $75, $50, or $100. They bought stability. They flooded the system with cash so that healthy banks could absorb the wreckage left by the exploded whale without collapsing themselves. They lubricated the system so the gears wouldn't seize from the friction of the crash. That $34 billion was the invisible hand catching the falling knife. Without that injection, markets could have been halted, limit down stops could have triggered, trades could have been canceled. The fact that we're even looking at $75 today is a direct result of that intervention, and that number tells us something else that matters deeply. The paper silver market is extremely fragile. Imagine a house of cards built on leverage. The wind blew hard today. The only reason it's still standing is because the central bank propped it up with freshly printed money. But here's where it gets interesting. While the Western financial system was printing $34 billion to plug the hole caused by paper derivatives, the physical world was watching and laughing. Because while the paper price collapsed, the real metal did something completely different. Now we reach the most important part of the story. If you want to know what a market truly thinks, you don't listen to noise, you look at price. While New York was burning at 2 a.m., there was one market on Earth that didn't care at all about the crash. That market was Shanghai. If you want the truth about a crime, you don't ask the suspect, you ask the witness. And the witness to this crash was the Shanghai Futures Exchange. While the West was busy burning wealth, China priced silver as if nothing had happened. When the Shanghai session closed, the front-month silver contract was trading at 20,073 yuan per kilogram. Let's break that down simply. Divide 20,073 yuan by an exchange rate of roughly 7.04, then divide by 32.15 troy ounces per kilogram. Result $89.18. Now stop and think. West, $75. East, $89. Difference, $14. This is not market inefficiency. This is not a small divergence. This is the signature of a broken market. A $14 spread in a commodity is absurd. It violates basic economic laws. In a normal world, arbitrageurs would buy at $75 in New York, sell at $89 in Shanghai, and close that gap within minutes. But it isn't closing. Why? Because as of January 1st, new export licenses created a shield around China. Metal is locked inside. Getting it out is difficult. Flow stopped. The global market split in two. There are now two silver markets. Market A, the Western paper market, run by algorithms, derivatives, and Ghost Week. Liquidity. No physical delivery pressure. Price, $75. Market B, the Eastern physical market, driven by industry, solar factories, and strategic stockpiling. Real demand. Price, $89. Now ask yourself, which one is real? A cash-settled paper contract, or physical metal being delivered into factories? China is showing us clearly. The real price is $89. The New York price is a story being told to you, a story banks need you to believe, so they can build positions before the inevitable rebound. That $14 premium is the strongest evidence that the crash was fake. If silver were truly abundant, Shanghai would have fallen too, but it didn't. It's holding near $90. That tells us this: the Western crash is entirely synthetic. A story algorithms tell other algorithms. The physical market is not crashing. The physical market is saying, we'll take all your silver at $75. Thank you. Now, let's talk about the most dangerous lie being told in financial media today. You turn on the TV. The headlines are the same. Retail investors panicked. Small investors sold. The silver bubble popped. This narrative targets you. It blames you. And let's be honest, it's a lie. It's not even mathematically possible. Because today we don't guess who did what. We look at data. Flow data, volume data, ETF inflows tell the story clearly. When price fell to $73, do you know what happened? Inflows into SLV and PSLV increased. Online bullion dealers saw volumes triple compared to a normal Monday. About 90% of that volume was buying. Retail didn't sell. Retail bought. Small investors saw the price and said, thanks for the discount. So let's ask the real question. Who dumped 5,000 contracts in a single second at 2:15 a.m.? The investor in Ohio? No. A silver stacker? No. This was a forced liquidation. The collapse of an over-leveraged institutional whale. A robot executing a bankruptcy order. The selling came from an entity with no choice. Not from a human opinion, but from an algorithmic obligation. But the media can't show you that, because they can't say this. A major institution failed. The clearing system shook. The system survived only because of a $34 billion emergency injection. If they say that, real fear begins. Trust in banks erodes. The system gets examined, so they need a scapegoat. And that scapegoat is you. They call you an uninformed retail investor. They gaslight you. They make you doubt yourself. Because they need your silver. Remember this: 600,000 ounces of physical silver left the Loomis vault. There is a $14 premium in Shanghai. January 2nd is only days away. Smart money is desperate right now. They must secure physical metal before the rules change. And there's only one way to do that: by scaring you. They crushed the price. Now the media is coming for you. But data doesn't lie. Today, retail investors are the smart money. You are buying at $75, what China is buying at $89. You're the one holding the lifeboat as the Titanic hits the iceberg. Now we reach the final major piece of the puzzle. The selling is done. The whale is dead. Forced sellers are gone. The market is clean. No leverage. No forced liquidation left. Only two groups remain: believers, physical buyers. And do you know what happens on January 2nd? Institutional desks return from holiday. Pension funds, sovereign funds, allocation funds open their 2026 portfolios. Billions in fresh capital enter the system. And where will that money go? To the best performing asset of 2025, with undeniable structural deficits and screaming physical scarcity: silver. That's why they're pushing price down today. That's why they're creating fear. That's why they're trying to shake you out. Because when those buys arrive Thursday morning, cheap silver will be gone. This won't be a slow recovery. This won't be a gradual rise story. This is a slingshot. The further you pull it back, the harder it snaps. I don't believe we crawl slowly to $80. I believe we gap higher. Open at 82, then 85, then 90. To close the spread, the market will try to correct 2 weeks of distortion in 2 hours. But I warn you, this will not be a straight line. When volume returns, volatility will be stomach churning. We will see $10 moves in a single day. Banks will try one last time to run stops. They'll shake you in both directions. If you try to trade this, sell at 85 and buy back at 80, you will be crushed by algorithms. There is only one strategy: do nothing. You already hold the winning ticket. You bought the medal. You survived the Ghost Week trap. Now all you have to do is sit on your hands and watch the show. Let me be absolutely clear. This $75 drop was not random. It was not a mistake. It was not an accident. It was the final test. The last opportunity banks had to get their hands on your wealth before repricing begins. Ghost Week exists for this reason: low liquidity, high fear, people alone and vulnerable in front of screens. This week is designed to separate the strong from the weak. If you panicked and sold today, the system won. If you did nothing, you passed the test. Because this market never rewards the right. It rewards the resilient. Banks know this very well. Physical scarcity is coming. The arbitrage mechanism is broken. The Eastern price must consume the Western price. And when everyone realizes this at the same time, cheap metal disappears. That's why they suppressed the price today. That's why they hunted stops. That's why they unleashed the media. But it's over now. The whale is dead. There are no forced sellers left. Leverage has been cleansed. Everyone remaining is here by choice. And that is extremely dangerous, because there is no longer a mechanical force left to push price down. Now let's clarify one final, critical point. $90 is not a target. $90 is a threshold. $90 is simply the moment when the West accepts what the East already knows. The real question is this: what happens when the paper market surrenders to the physical market? History has answered this many times. A delivery squeeze. Squeeze occurs. Inventories evaporate rapidly. The concept of price suddenly loses meaning. At that point, price doesn't move step by step. Gaps appear. Charts tear. And most importantly, there is no going back. Today people say, I wish I bought at 75. Tomorrow they'll say, I wish I bought at 90. Then there will be no chance to say, I wish. Because this is not just a price story. It's a global repricing. The era of cheap silver ends on New Year's Eve. The just-in-time delivery era ends. The we'll always find supply era ends. What begins on January 2nd is this: the era of real pricing. At the end of this story, the winners will be those who looked at data, not fear. Those who looked at structure, not price. Those who trusted physics, not algorithms. This week was built as a trap. The reward is for the strong. If you listened this far, if you didn't panic, if you didn't sell, you passed the test. From here, there is only one thing left to do: wait. Because the market is no longer moving at your speed. It is moving at the speed of physics. And physics doesn't listen to debt. It doesn't listen to algorithms. It doesn't listen to headlines. Physics only enforces reality. This is Land of Finance. Thank you for watching. If you want more content like this, don't forget to like the video, subscribe to the channel, and share it. History hides the answers. Let's look at them together.